this is the kind of inflection point. We saw this, I think, the last time we saw anything of this scale, and it took years to resolve, as opposed to just really 4 months worth of correction, was back in the 2013, when we saw the 2008. We saw an initial very similar initial dollar scramble for dollars, and we see the price come down a bit, and then off it goes, and China buys, and everyone's buying, and then 2013. I remember publishing the ABN AMRO letter on the 1st of April, which on the end of actually March of 2013. And if you remember, that was the time when the PPT, the plunge protection team, came in after a meeting with the presidential meeting with all the bullion banks and smacked it down. It was 4 years of downside. We've just had this done in a 4-month period of the same kind of scale. Tell us what you're seeing, Andy. I can't wait to hear.
Well, I mean, I think that the gold and silver coming down, Andrew, changes nothing. It's the same game that's always been played. The paper markets push price around, and strong hands are accumulating the real metal. I don't think lower prices are weakness. To me, they're an opportunity this time. And I mean that sincerely, because this is accumulation. This is positioning. There's a buyer for every seller, and the buyers of this panic are the smart money traders, the people that know the fundamentals haven't changed. And to me, this is only normal sediment reset to build a fuel for the next leg up. You know, let's talk about silver for a moment. We talk about this movement down, this correction, which the Bank of International Settlements came out and said, look, this move in their mind is structural, not fundamental. Well, what does that mean? Well, they say that it had to do with the massive influx of metal running into the levered ETFs that all had to rebalance in January, along with the massive increase in margin requirements on the CME that went up over 300% in a month, specifically designed and targeted to squeeze the speculators. Had much more far-reaching effects into the retail industry and the refining industry here in the States. But what it really did is it absolutely blew up all of the speculators who had to post 300% more margin in a period of a month to keep their positions open. When they didn't, selling beget selling, beget selling, beget selling, beget selling, and bang, the price collapses. We see banks like JP Morgan covering at the very bottom. We see massive deliveries, not just on COMEX, LBMA, or Shanghai, but I think it's very interesting. Let's start with China. Bloomberg just reported that the Chinese custom data says that 790 tons of silver were imported by China in the first 2 months of the year. February alone, 470 tons, the highest monthly import volume ever recorded, while the price got its teeth kicked in. So while paper gets pushed down, China was vacuuming up physical supply at every available shelf on the planet like it's never been seen before. And we saw 100 tons of silver leave the Shanghai market in the period of a week. So big money is standing for delivery across the globe. We've seen in the last 6 months, 200 million ounces of silver in the registered category, September of 2025. 6 months later, we're right here, and it's about 78 million. So over 120 million ounces have been drawn down in 6 months. Who's doing this? We look at February here in the States, which is a non-delivery month, right? You can take delivery, but not a primary delivery. Roughly 25 million ounces delivered on COMEX. One of the smaller deliveries we've seen in the last year and a half, but 160% of what deliveries could explain alone, roughly 38.5 million ounces, left COMEX. That's over 2 million pounds. Who is arranging the logistics for this? Who is putting all of those bars on semi-trucks and driving down the street with insurance and logistics, and where's it going? Is there a coincidence that it has been classified a critical mineral? I'm just saying. But we're seeing the same thing in gold too. Massive deliveries, huge deliveries. And to me, Andrew, price is just a tool of misdirection. Now, if I had to be completely honest, I feel that indeed this correction was completely structural because of the structured changes, not fundamental. And I also feel as though the banks that have been playing these games for a very long time realize, for whatever reason, that being on this side right now in a market where traders have now come to the conclusion that what the West has been doing is a way to control prices, and they figure the way to win the game is to stand for delivery across the globe. We see that, and it's almost as if they're trying to get on sides. And you look at what Ed Steer just said. He said the commercial banks right now have the lowest short position in history in silver. So could the Economic Times be right that the banks in the United States are flip-flopping, trying to get net long, using these drawdowns with massive leverage that is very not organic, let's say, or what's happening with Jane Street and the theories behind that? Could it be that they were using these episodes to go long, to flush out the speculator, to flip-flop sentiment that was wickedly bullish for a while and now has fallen, to allow the fuel for the next leg up? And I'll say this, to me, the one thing that the media has missed more than anything, they've talked about price, they've talked about all the negative reasons why gold didn't, shine in a period of war, and all of these things to make it look bad. Silver, the devil's metal, they call it, overbought, fundamentals look bad. It's another 1980, it's another 2011. The one thing that they've missed more than anything is who the hell is standing for delivery to the tune of billions and billions and billions and billions every single month for about a year and a half now, and a lot of it now being loaded out of the exchanges. So to me, that's the only thing that matters. Everything else is a distraction. Everything else is noise. The most well-informed traders on the planet, starting with the central banks for years, as you and I have talked about, now moving to whoever the hell is doing it here in the United States, which I have felt for a long time was the Exchange Stabilization Fund, doing it on behalf of the Treasury for national security, therefore does not need congressional approval. But who's standing for delivery for literally billions every month?
And when you think about it, if you try and go buy silver in London at the LBMA, it's a bilaterally settled contract. Therefore, the reference price at the fix, forget it. It's nothing to do with that price at all, because now, and the bigger the size you want, the higher the premium. So essentially what that does is kind of put the COMEX in the crosshairs where you can actually load out some inventory. But I'm running into problems here, or my liquidity provider recently ran into a problem. They're saying, look, they don't want to let me have it. Essentially what they're saying is that because of export controls, all of a sudden now, if I'm a PBOC buyer or I'm a foreign entity and I want to take that silver because I haven't got any and my inventories are at record lows and I want to restock, I go to the only source that I can actually physically load it out from should be the COMEX. But there's export controls. And I think it's leached down to the word on the street is, no, make them a price. So what our liquidity provider said happened to him was he was told, right, tell you what, here's your settlement price. It is whatever we can determine at the LBMA for a bilaterally settled price, which is plus the 8% for lease costs and one thing and another, and then the additional cost to ship it out, they still find it worth the arbitrage. You can't get it right out of the COMEX. So the arbitrage, whereas we've seen silver, Shanghai silver running around about a $10, 13% premium, all the time to what's been going on consistently.
Months and months and months, yes.
Months and months and months. So now if you can't get it out of the COMEX, the price settlement that you're being cash settled for is enough to then go to the LBMA, force them to lease that bloody gold onto the market, which is about 8% in addition, plus the extra cost. And they're still doing it, because they just need the silver. And even though the arbitrage has kind of been taken out of it, they need the silver and they're taking it. So this drain is under the radar going on big time and people don't get it.
Well, look at it the other way too. Okay, so the Chinese have the arbitrage at roughly 13%, whatever. Okay. But what people are missing on that too, and there's been a lot of question about it, and I'm pretty sure I'm right on this. I've tried to dig as deep as I could into it. There are a lot of people who are confused about the VAT tax on the importation. To my understanding, it is the recipient's responsibility to pay the VAT tax when it leaves the Shanghai Metals Exchange. So if a trader has the ability to deliver it to Shanghai, not only is Shanghai paying a 13% VIG, if you will, on the premium, but a pretty damn close to a 13% VAT tax as well when it leaves. They're willing to pay 26% above the Western benchmark price because that's how bad they want it. So, you look at it from a standpoint of what really is the price. And then you look at India saying, well, we're not going to even trust the Western price anymore. So let's set that aside for a moment. And then you look at the exchanges that are being built in the BRICS. They are going to build